What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are discussing the fact that inflation is already starting to rear its ugly head across a number of key factors that are early on in the production chain that will lead to price inflation across the board in many areas over the next 6 months to a year, leading to an increase in prices that are likely to make it extremely expensive for the average person to be able to afford life in general. Let's dive in. If you are new to the channel here, you might not know, but I have been talking about the coming inflation for a while here, since the beginning of the channel about a year ago, and talking about how the devastating consequences of monetary expansion and the monetary and fiscal policy that our government and the Federal Reserve has been engaged in for the last couple of decades is going to really start to wreak havoc on our economy and our citizens very soon here. And so as a result of the coronavirus, we are already starting to see some big inflation numbers start to pop up in some key areas that are going to lead to more and more price inflation going down the road. Now, for some background information, I'm talking today about price inflation. This is something that is commonly confused across the board, and whenever somebody says the word inflation, you want to figure out very quickly, are they talking about inflation in the modern definition of the word, which is price inflation, or are they talking about inflation in terms of the classical, the traditional usage of the word inflation, which used to mean monetary expansion? If you go back and read any economic literature or any economic textbooks or writings about finance from the early 1900s and the 1800s, the word inflation, it was always used to talk about monetary expansion. It's the supply of money that expands and contracts. It inflates. Prices don't inflate; they either go up or down. That's inflation, and that's why the word is inflation and deflation, is because it was originally talking about the supply of money, the supply of money either contracting or expanding. Whereas prices, they go up or down. But because prices are influenced so heavily by monetary expansion or contraction, that's why the word inflation eventually became to be used to discuss the actual prices, because price inflation, or prices going up or down, is pretty much a direct result of what happens to the money supply. And so today we're talking about how price inflation is already starting to rear its ugly head in actual goods, in actual products. Because again, you've been around the channel for any amount of time, you know that we've been talking about the massive amount of inflation that we've seen in asset prices already. And if you've been watching the stock market at all, you know we've seen this. By any metrics, stocks are at pretty much the most expensive valuations they've ever been at before. And so what we're seeing in terms of the price of stocks is a reflection of the value of the dollar going down more than anything. I'd rather own a piece of a business that will stick around and eventually produce dividends or returns, or can be denominated or priced in a different currency, than hold a piece of paper which over time only loses purchasing power. And so that's part of what we're seeing right now. Money, wealth floods into assets when cash or currencies start to go downhill. But the second stage to inflation comes after asset price inflation is consumer price inflation. And the one most dangerous place that we're starting to see this show up right now is in food. Now, I'm going to throw a really boring looking table up here, but you can see here this year, 2020 at the bottom, each month, we are currently seeing some of the largest year over year inflation increases than we've seen in years, really since 2008 there. Now, this makes sense from a monetary inflation, a monetary expansion standpoint, because when you have a pie of wealth, a pie of goods and services, and the only thing you do to that pie is throw more money into the pie, the only thing you're doing is taking a pie that has, let's say, 8 slices to the pie, and you're cutting each slice in half. So now there's 16 slices of that pie, but each slice is half the size of what they were before. And so it doesn't do anything to the size of the pie. The size of the pie stays the same. It just takes more slices now to make up the same amount of pie as it did before. So when you have an economy that goes through some sort of crisis, the amount of goods the amount of actual products in the system either stays the same, or in a lot of cases it goes down. Like right now we're seeing a massive decrease in supplies because of supply chains being broken, especially internal supply chain, like not just from China, from shipping and stuff, products. I'm talking about even locally, like food. Farmers can't get food to the grocery stores because the supply chains, a lot of them are meant for restaurants. Restaurants are shutting down or not being open, not placing the same amount of orders. And so we're seeing a lot of breaking taking place in the supply chains, especially in food and agriculture across the states. And so when you have a pie, right now, we haven't seen our pie really stay the same, pie of goods and services. It's actually shrunk. And in response to that, they've thrown more money into the system. Well, if the pie stays the same and you throw more money into the system, that takes more slices to make up the same amount of pie. But if you have the actual pie decrease in size and you're still throwing more into the system, that's only going to make the problem worse. So prices are going to go up a lot. Now, it takes time for this effect to happen. And the reason why it takes time for this to happen is because they don't give all the money out in equal proportions to everybody. Imagine a stock split versus a secondary offering. In a stock split, if you have one share, now you have two shares, but each share is worth half. Your value didn't change at all. It's an equal split for everybody. Everybody gets the same number of shares in proportion to what they already owned of the company. And so there's no effect or little effect on what it does to the actual value of every person's share of that company, every person's portion of their wealth held in that company. Versus a secondary offering, they're issuing new shares into the market, but those shares are not being equally distributed to all the existing owners. And the new money that is raised from those shares are going to be spent in a way that ultimately they do think will have a beneficial impact on the company, but they might not. And so you have a disproportionate amount of wealth being removed from the existing shareholders through dilution of new shares entering the market, and then that capital that's withdrawn from all of those existing shares gets redeployed to, build a factory or something like that. And so what the Federal Reserve and our government does in with their actions that cause monetary expansion, an increase of the broad money supply, that's a lot more like a secondary offering. They're scalping purchasing power from every existing dollar and then redeploying that into an area that they think incorrectly will help the economy. Think of it like this. You're playing a Monopoly game with your friends or your family, and the banker decides everybody's money gets doubled. So you had $1,000, now you have $2,000. Everybody across the board, everybody playing the game gets double the amount of money that they had before. Well, very quickly, people would stop selling Boardwalk or Park Place for $400. A bidding war would ensue on properties because everybody has more money to play with now. And so a bidding war would escalate, and you would see the prices of everything across the board start to go up. People would be able to afford houses and hotels for their properties a lot more easily. And so those would be placed on the properties. So rents would very quickly start to go up. And so you'd have an almost instantaneous increase in prices, in price inflation across the board, if everybody's money supply was increased proportionately immediately. So that's why the Federal Reserve doesn't like helicopter money. Because if everybody, let's say you're worth $10,000, immediately the Federal Reserve gives you another $10,000 to double your money, or triple, or in proportion to how much money they were printing. If they did that for everybody, immediately you'd see massive inflation. And they can't have inflation start to show up in the numbers because they need the ability to continue to print more money without it actually showing up in inflation numbers, because then people will demand a higher interest rate on their debt, which will crush their ability to do what they want with monetary policy, because that's really reliant on them being able to continue to keep rates really low despite the inflation that's happening. And so they don't want inflation to show up in the numbers. So that's why they don't give helicopter money proportionately to everybody, because it would immediately bid up prices of everything across the system. So instead what they do, going back to the Monopoly game, is the banker decides to give one player double the money or one player triple the money. aka the federal government. They give the federal government a ton of money through this inflation, through monetizing the federal government's debt, and then the federal government can then go and spend that money as a federal government wishes, and then it takes a lot longer for all that new money to make its way into the system, bidding up the prices of everything along the way. So the first recipients of that new money get the benefit of being able to use a ton of money at the old prices. And then as that money gets spent throughout the economy, gets transferred, bought and sold throughout the economy, as various players get their hands on it, eventually it will work its way down to wages, right? Because wages are going to be the last things that monetary inflation or deflation ever impacts. And so eventually it'll make its way down to wages, as wages are forced up either through competition from price inflation or from minimum wages. But by that time, the cost of living has already outpaced the increase that wages see. And so people who rely on wages are usually going to be hurt the most, especially the ones who don't hold any assets. So again, it's the poor that are hurt the most from this, and it's the people who are controlling large corporations, who are on government contracts, government employees. They're the ones that get their hands on the new money first, and then they get to take advantage of low prices. They spend that money, they get the benefits of that at the expense of everybody else down the chain. Now, because of the coronavirus, like I said earlier, we're starting to see food inflation really take off. Take a look at this chart as well. In addition to the boring table that I showed you earlier, this chart shows you the kind of the breakout here in price inflation that we're starting to see in food. And I'm going to throw charts up here on the screen one by one here. We're starting to see massive price increases in iron ore. We're starting to see it in copper. We're starting to see it in lumber. We're starting to see it in nickel. We're starting to see it in zinc. And obviously, if you've been around the channel for any amount of time, you know that we've been seeing it be foreshadowed in the gold and silver prices for a while as well. Gold more than silver by a lot, actually. But in any case, we're starting to see commodities are really starting to show the inflation that is coming into the system right now, as the price of things increase due to the fact that there's more money chasing the same amount of goods. And when commodities prices increase, you know that soon that means that the end product price will increase, because if it costs companies and suppliers and factories more to make, if it costs them more to make the same goods, they have to pass those price increases along to the customer. Otherwise, they won't be profitable. And if they're not profitable, they're just not going to make anything, right? Why would you make something at a loss? We're not the federal government here. And so the price hike that we're starting to see in commodities is foreshadowing a much larger price hike that we're going to see in end products across the system very soon here. Now, in conclusion, if you do want to shield your wealth from inflation, the only thing you need to do is rely on the trusty wisdom that the only way to know whether a politician is lying or not is whether his mouth or her mouth is moving. Where am I going with this? Don't buy tips. They're called Treasury inflation protected securities, which means they are definitely not inflation protected. If you want to protect your money against inflation, you need to put your wealth into things like gold that have a very long history, thousands of years in fact, of preserving their purchasing power across regimes, across countries, across cultures, across history, across time. Things like gold are going to preserve their purchasing power, which is another way of saying they're protected against inflation. So don't trust your money to the one source that has constantly proven that it is the most untrustworthy source. Thank you so much for watching. If you enjoyed the video, hit that like button for the YouTube algorithms and share with somebody you think will like it as well. Really appreciate you guys. Have a great day.